Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back. Glad to be here. Glad when the election's going to be over. That would be nice. Get back to business as normal. Bashing whoever gets in office. But anyway, if you'd like to call in, the number here is 216-901-0945. This is the Bullington Capital Report, just like the guy said. Here every Saturday morning from 11 to noon, 6 o'clock on 1220. They replay the show. May do a couple of live shows here at the 6 o'clock Sunday hour coming up over the next couple of months, so you want to stay tuned for that. Because one of the tools that I've been using for years has had a pretty significant upgrade. It's made it significantly more, significantly easier to be able to do some of the things that I do. And we're going to be talking about that. We'll be talking about that forever now. It's just so much easier to go in and locate those stocks that are moving now to kind of determine what kind of health the stock market's in. That's so much faster than it used to be. It's mind-boggling, actually. And so we're going to talk about some of those things. We're also at the next seminar, we're actually going to be talking about being your own mutual fund. There's a technology that I use, and it's a brokerage firm. They're one of my preferred brokerage firms. And you're able to go in, design a portfolio, and then make that portfolio happen without paying individual transaction fees on each and every security that you're buying. And that's pretty awesome. The power of that is misunderstood and unappreciated. And I'm going to shine a little bit of light on that because it's a big deal. Even if you're only going to take a small portion of your money and invest that way, it's a big deal. The fact that you have the ability to do that is a big deal. And no one else is doing it. This is the only firm that's doing that right now. Eventually, maybe some of the bigger firms start to add this. I don't know. I doubt it. But they could. You never know. Anyway, I'm going to be highlighting that at the seminar instead of investing in stocks or funds, which you should still do. I mean, if you're a novice, this is something that you do with a small portion of your money. If you get to be pretty sophisticated, then you can do almost all of it. That's practically that's what I do. Almost all the money I manage now, I'm putting in some indexes that I created. And the money that that's not in a model, in an index that I created, then I'm doing that subjectively. And we're going to be talking about that a little bit too. Because, like I said earlier, the tools that we use for that, they've just gotten better and better and better. The latest iteration, the latest update has made it so simple. And it's so nice. And you can hone in on just those stocks that have the higher probabilities of going up right now. Because why? Because that's what they're doing. They're going up right now. Strong stocks getting stronger. You know what I'm seeing in that space? A whole bunch of technology stocks, primarily semiconductors. And that's been this way now for a while. Market hasn't been strong, by the way. It hasn't been conducive to trend following as a strategy because it's been so choppy. Trend starts to establish itself. Some bad news comes out. Market goes down. Most stocks go down with it. It's been a lot more difficult. And when you're in an environment like that, I'm going to show you how to identify that. I'm going to show you how to identify the difficult market and how to identify the easy markets, the ones where these strategies tend to shine. That's where you want to take the bigger position sizes. You want to adjust the risk you're taking based on market conditions. But first, you got to know how to figure out what those market conditions are. And it's improved. The tool I'm using has improved and made it easier. I think it's going to make it a lot simpler for individual investors. You can see whether or not the market is strong or weak. And you don't have to rely on the Wall Street Journal or Barron's, which, I get copies of both. But you don't have to rely on Investors Business Daily. It's a lot simpler than that. So anyway, and by the way, that's assuming that you're, oh man, jeez, just wrote all over my pants with a pen. I didn't realize it was open. That's pretty funny. Anyway. So if you can determine the strength of the market, that really should help you determine whether or not you should be aggressive or not. And see, that's a key. There's a time and a place to be aggressive. And I'm going to tell you right now, the conditions are not that good. They're not that good. Out of the top 3,000 stocks, basically the Russell 3000, 1,800 of them are in a short-term downtrend. Okay, that's more than half. That's not good. What you'd like to see is that more than 1,800 of them are in a short-term uptrend. That would be good. When market's good, when it's conducive, hey, then you take larger position sizes. And again, we're going to go through all this stuff. In fact, surprise, surprise, we're working on the resurrection of the old Look Out for the Bull website. Remember I had done this, and we were talking about this before. We had some subscribers. It was then the company that ran the website just stopped answering their phones and went out of business. Actually, that was the third time that had happened to me. 3 different carriers. I can't tell you how much money I spent getting the websites designed up and functional just to watch the web design company go away. So a little frustrating. And but as everything else, it's improved. This one's not going away. So look out for the bull. That'll actually be coming back if you want to know more about this. Because I think first of all, I think this is fun. It teaches you so much more about the market than you're ever going to learn in a book. You'll never learn this stuff in a book. But when you start looking at some of the tools, I'm basically going to cut your learning curve by 90%. That 10% is still significant. It's still a lot of effort. I mean, don't get me wrong. It's not a minimal effort that you can put in, but it's doable. It's manageable, even if you have a job. Another job, I mean. If you're retired, it's better. But I'm telling you that the tools have improved. The market's a little bit different than it used to be. I'm going to talk about that. That'll be part of that website too. So if you're really interested in this, just go to my website, bullingtoncapital.com. You can sign up for the seminar there. Don't buy a stock or fund. Be your own fund is the label. We're going to talk about a lot of different things over there. That's going to be part of it, which I think is a big deal. My high dividend model this year, it's like 3 times higher than the S&P is. Saying that, I'm going to tell you that all strategies lag from time to time. They all do. That one does. But this year it happens to be a really good year for that. And I have a feeling that the momentum models are going to start to pick up. So if you're out there listening and you already have an account at that firm called Folio, you might want to get to the seminar, figure out when conditions are actually improving. When they're improving, you might want to make a little adjustment and go with the momentum models. You might want to overweight your momentum models in your investments. And, if you know what that is. If you don't, then you really need to get to the seminar. But enough about that. This is it's exciting. I'll tell you what else is exciting. First time in several years, GDP growth getting close to 3%. First time, several years. Actually, I think it's 8 years to be exact. And it's the longest time period in the history of the country with sub 3%, 3.5% GDP growth. Think about that for a second. We set a record this year. Actually, we've been setting records each year for the past 3 years. Low GDP growth. When GDP is gross domestic product, basically it's the size of the economy. How much business are we doing? How many cars does Ford sell? How many houses are being sold? How many sales does Walmart, Target have? Add all the business together and find out, how have we done as a group? That's GDP. When GDP is not growing very quickly, stock markets typically don't go up a lot. When GDP growth is growing pretty quickly, they generally go up more. The stock market, by the way, is typically several months in advance. The stock market will typically move several months before GDP growth has started, which is kind of interesting because it hasn't really started moving in a big direction. It's not that strong. It's still pretty weak. So I'm looking for that. GDP growth at this point in time, actually, I would say this year, it's throwing that rule on its head. GDP growth has been a little bit faster than the stock market. No, I take that back. Stocks are up 6% this year. So I'll take it back again. But again, stock market typically is a leading indicator. And when you get a really big move, the fewer people that believe it, the better the move's going to be, by the way. When everybody is expecting stocks to continue going higher, it's typically because they've already been going higher for quite a while. They've seen their account values growing significantly, and they just like to project that in the future like it's going to happen that way forever. And that's exactly the opposite of what they should be doing. They should be concerned when that's happening, and they should be greeting lower markets with a healthy dose of skepticism, but also with open arms, because you've got to go through those to get to the other side. And the trick to that whole thing is called balancing your portfolio out. Stocks, bonds, and cash. You need to balance that out. I'm not sure you're going to need, at some point in time, inflation probably will kick in at a much higher rate. I don't know when. Nobody knows that. At some point in time, all those funds you've been holding, those real asset funds that have done nothing but pull your portfolio down for the past 5 years, okay, they may actually start to pay off. At some point in time, MLPs may go up and break new ground. At some point in time, they will. I'm pretty sure of that. Just don't know when. And they still have a nice yield, an extremely nice yield. It's got lots of tax advantages. And you can invest in it through product now, where you can keep the income, get rid of the paperwork of an MLP. That's a good idea, I think, for a lot of people. Before I get out of this, I think we've got, I got a couple minutes left before commercial break. But listen, if you'd like to call and ask a question, 216-901-0945, or you can email us, bill@bullingtoncapital.com, or just go to my website, click on the contact button, send us a note. I have been getting a couple of emails, and you know what? The questions were kind of specific. Some of the questions I get are pretty sophisticated, actually. The people that are asking them typically don't realize just how sophisticated they are. The answers to those questions are incredibly complicated, and I'm not sure that would be very conducive to keeping one's attention on a radio. So if you hear me not answer, if you have sent something in and I haven't answered it, just give me a call in the office. It's because the answer is extremely complex, and when you're out there driving, it's really hard to catch the easy stuff. Never mind the really complicated stuff. But I will tell you, the last thing, I think we have a couple minutes here before we go to break. But I actually got 4 minutes. That's good. I sent out a letter to my clients this week. I was talking about an investment-only annuity. There are lots of annuities. A lot of them aren't very good. A lot of them are. But you've got to really be careful when you're looking at annuities. The annuities that guarantee your principal, the cost of doing that is so high, you're probably not going to make much, if any, money at all. And if you pull your money out or somebody dies before they're out of the penalty period, your beneficiaries end up inheriting a lot less than you started with. Think about that for a second. One of the reasons you got into it is so that your beneficiaries would not lose any money. Those annuities are not doing that. There are other types of annuities that will guarantee a death benefit. They're basically adding insurance to the policy. Okay? And that it's expensive, incidentally. The insurance is very expensive. In a lot of cases, you'd be better off just buying life insurance and having a balanced fund. So what I'm trying to get at here is, if you have an annuity or you're thinking about investing in one, talk to us first. We've got an annuity comparison program. It's free. You tell us which one you're thinking about investing in. We'll look it up. We'll find out what the particulars are. Or if you've been given an illustration by somebody who sells those products, send it to us. We'll break it down, analyze it. If you already have one, You can send us a copy of your statement, and we will take a look at that and just show you what you have. And if there is an ability to make a change to it that might improve your situation, we'll let you know. If not, we'll tell you that too. So another thing that just popped into my mind. So that's an annuity comparison service. If you're thinking about doing one, especially with taxes bound to go up, I don't care who gets in office, what they say, sooner or later, someone's going to have to start paying that $14 trillion in interest-bearing debt. Probably going to be the rich people. Probably just going to be people in general. Okay, so if you got a large taxable account outside of an IRA, you can put as much of these into them as you'd like. There's no cap. There's no insurance with this, so the cost is the lowest on the planet for this one particular product that I'm thinking of. And you have 360 funds that do everything in the world there. There are funds that invest in gold. There are funds that invest in natural resources. 360, more than you can. Actually, there are more funds than there are categories to invest in, because each one of those categories has more than one fund. So it's pretty wild. You're not capped the way you are on a non-deductible IRA. You can put as much money in as you want. There's no cost in or out. There's no, here's what a lot of the guys I hear on other radio stations in the area, they say, oh, yeah, there's no cost to you. You're not telling them about the contingent deferred sales charge because you don't have a securities license. You're licensed you have an insurance license. Then the state of Ohio's Department of Insurance is understaffed and overworked, by the way. Those guys deserve a pay raise for what they're doing. And those guys are getting away with saying things that just aren't true, and drives me nuts. But full disclosure, that's the way that everybody should run their business. Full disclosure. What are the good, the bad, and the ugly parts? Everything's got advantages and disadvantages. So just take a look at it. Go in with your eyes open. Try to find out what kinds of things, what kind of penalties you might get. And again, that's why we offer this service. There's no cost to it. You can send us a contact form. It's go to my website, Bullington Capital, click on the contact button, tell them what you'd like us to do. We'll look it up, draft up a report for you, and give it back to you. And I looked at 2 this week. And over the past month, well, there's music. That means I have to take a commercial break. Listen to Bill Bullington right here on 1420 The Answer. We'll be back after these messages.
It's astounding. Time is fleeting.
And we're back. Hey, if you'd like to call us today, 216-901-0945. Feel free to call, ask any questions regarding investing. Investing actually gets shortchanged. It's plays such an important role in your life. There are 2 things you need to do to be financially successful. First thing is you got to learn how to live beneath your means, not within your means. You have to learn to live beneath your means. And realistically, if you're young, you're out there, you should be saving about 15% of your income. That's a difficult thing for an awful lot of people. You should see the eyes roll when I say that at a corporation or or a group. How am I supposed to do that? Well, same way your grandparents did it. Suck it up. Yeah, that's the bottom line. And if you got a job, you're not building a business. And some business owners, you own a business. I get it. I own a business. I had invested an enormous amount of money in my business. And I understand that. But you're building you've got an asset. Hopefully you're still putting something away. And hopefully it's earning some money for you. Hopefully you're doing better than the average investor who, according to Dalbar, a company that just studies the investor behavior in the United States, the average U.S. investor over the past 20 years has made a little bit over 2% a year. Woohoo! In the meantime, the average balance fund's done closer to 7%. So, it's important. It's important that you understand this stuff. It doesn't have to be extremely complicated. In fact, a lot of the stuff that I do is incredibly simple. And I like the simple stuff better. It tends to have the fewer moving parts, the fewer chances of something going wrong. So it doesn't have to be really complicated. In fact, my two favorite strategies are the high dividend model we have and the momentum model. I've got other models. It's just that I like these better, especially the more experience I've had with them. The things I'm seeing happening in the stock market are causing me to lean more towards those two strategies. And we'll talk about that when we do the seminar coming up that you can sign up for free by going to my website, bullingtoncapital.com. And I forgot what date it is here. I have to go back and see. Oh, it's November 17th. That's a Thursday. That's actually the Thursday before Thanksgiving. So you go to that one, you'll have one more thing to be thankful for. The November 17th, 7:30. And I'm going to show you how I use that tool to build my own mini funds. It's basically what we do. Each account I manage has the same stocks in it in proportion to the amount of risk that they want to take. So I'm going to show you how to do that too. We're working on a lot of stuff here. It should be a pretty productive fourth quarter. I don't know if anybody's told you yet, but I think the Salem, the owner of 1420, has purchased some FM rights to be able to broadcast on FM. So in the spring, this show will also be available on an FM signal, which I think is kind of cool. That should be really nice. Anyway, in the meantime, we're just going to keep doing what we're doing, looking at using the latest tools. Tools are constantly changing. They are improving. Market conditions have changed. The market is not the same as it was in the late 90s, early 90s, late 80s. Actually, I think it would probably be, there isn't a time where it's been like this. It's a little bit different, but the adjustment that you have to make is more psychological than anything else. It's a psychological adjustment because stocks can still only move in one of three directions, up, down, or sideways. There are no other directions. So it's just how they do it. What fashion are they doing it in? That's been a little bit different, mainly with the advent of computerized trading, high-frequency traders. Volatility levels on a short-term basis have picked up pretty significantly. The long-term volatility is not all that much different, which I find really interesting. It's really not all that much different. But if you're an investor and you buy a stock, that stock could be up or down 20 or 30% in a single day. That's happened 4 times in the last 6 years that I can think of, where most stocks were up or down minimally 10%, some of them as much as 20 or 30% in a day. Okay, that is the new part. That wasn't that way before, not before the high-frequency traders got involved. So, but there are ways of dealing with that. In fact, buying a basket of stocks is a great way of dealing with that. The two portfolios, my favorite ones, have 40 stocks apiece in them. Doesn't matter that it's 40 stocks because the technology that we're going to be talking about at the seminar, and the one I'm talking about right now, allows you to buy fractional shares. So if you don't have enough money to, let's say Google ends up showing up in one of the portfolios, and it's over, it's $700 or $800 a share. Yeah, it'll buy a piece of Google if that's what it warrants. It'll just buy a fraction of that share. And again, these guys are the only ones that are doing it right now in the fashion that they're doing it. They don't charge commissions either. So essentially, you can create a model and be just like the mutual fund manager or the ETF managers in particular. Exchange traded funds, that's what ETF stands for, by the way. It's a fund that you can buy or sell during the day. But you can buy baskets of stocks, and I think there are lots of things that you could and should be doing. You're buying healthcare stocks, and you're buying market cap weighted. At some point in time, those are the ETFs. At some point in time, that's not going to perform that well. At some point in time, you're going to wish that you had the same stocks, but you had them equally weighted. You had an equal amount in each one of them instead of 20% in one big stock or over 10% in 4 big stocks, and the other 60% gets divvied up amongst 50. That's what market cap weighting is. Eventually, that hurts you. In a short run, over a 2 or 3 year time, or even a 4 or 5 year time period, if the bigger companies are doing well, you can actually do better by investing them. But I'm telling you, at some point in time, that comes back to haunt you. So for my money, I'd rather know that. And with a firm like this, you could actually carry both. You can have both of them in your account. There's no, this is America. You're free to do anything you want to do if you know how. If you know how to do it. So it's a really good tool. And again, the seminar's called Don't Buy a Stock or Fund, Be Your Own Fund. I'm going to bring back out I'm just going to spend about 15 minutes talking about the Lookout for the Bull website. A lot of people have been asking about that over the years. Are you going to do that again? Are you going to do that again? And let me tell you, I stopped because the technical difficulties, the companies would go away, and it was really expensive. It's a lot less expensive today to get a website designed than it was then. And then the maintenance is significantly easier. It's not easy, mainly because you've got people come in and forget their website, password and user ID every day. And you have somebody's got to be there to answer the phone or at least answer the emails and reset the password. So I was doing that. I've got a person in my office now that's going to take care of that. So I won't be doing it. Someone else will. And that's a good idea. So I'm going to bring that back. We'll start talking about some individual stocks. There's one company that comes up on the screen today, actually on Friday. And this stock is just screaming. I don't know if it'll keep going or not. Nobody ever does. But it's unbelievable how much that stock jumped in a day. I shouldn't say unbelievable. It's just, when you look at the chart, it looks bigger than it is. Anyway, that's the kind of thing that you're looking for. If you want to do an individual account, we're going to pick stocks. And you don't want to be a value investor, which means, a value investor buys a stock like Rail, like the one I bought, that I'm still down on. Actually hit not quite a 52-week low, almost a 52-week low this week. But at some point in time, that company stands a really good chance of selling to someone else for a much higher price. And I won't get into it now, but that's the challenge of value investing. You buy stuff that's a good deal, and 6 months later, it's a better deal. And there's no way of avoiding that. If you're a value investor, you're going to go through it. And while I'm talking about that, might as well talk about Genworth too. Here's an interesting thing. Genworth, spun off of GE, they decided to sell themselves to a Chinese company for $4.43, or for $5.25. So $5.25, I think, was the sale price they negotiated. So why is the stock down to $3.98? The day after they make that announcement, the stock drops and it keeps dropping. Well, I'll tell you why. Because the mutual funds that own that stock, that realize that company is going to go away, they're just getting out of it now. They don't care that they would actually have gotten a little bit more money to wait. They're selling it, which may create an opportunity here. Because I didn't buy the stock. I bought the right to buy the stock at $4. Right now, I would lose half the money I invested in it if I sold it. If I sold that right, I'd be down 50, actually more than 50%, because there aren't that many traders in that same option that I have. Here's what I plan on doing with that. So I'm going to take the loss. I'm going to extend the right out probably a year, or not a year, maybe to another strike price. It might go down to a lower strike price. Now, if nothing happens, by the way, I have I basically bought the right to buy the stock at $4. If nothing happens today, it would actually be worthless. If it goes this way for an entire year, the money that I put in that would be worthless. So that's not an investment, that's a bet. And that's what we talked about when that's a bet. So I didn't put a tremendous amount of my net worth in there. I would never do that on a bet. But here's what is really funny. If they're going to be bought at $5.25, if you buy the right to buy that at $4 and you get paid, they're going to give you the cash for that. The market maker has to pay you that difference. Okay, it's not the market maker; he's selling it to someone else. By the way, he or she. And so I can actually take possession. I've got the right to buy the stock. I just go in and exercise my right, buy it at $4, and get $5.25 for it. How cool is that? That's a pretty big deal. That's one of the reasons I like to do the long-term thing. I have plenty of time. I got plenty of maneuverability. If I want to take the write-off this year, I just buy a similar call on the same thing, and if the stock stays down here, I've got the right to buy it. When they do the cash transaction, they're gonna have to pay me the difference between that. Now, before I say that for sure, let me double. There may be some sort of a caveat or a loophole. I was just thinking about that this morning on my way to the radio station. There might be a loophole that would get the option market makers off the hook. So, but here's what my current thinking is: I got the right to buy it at $4. At some point in time, before that stock, that stock's going to go to $5.25. They're going to pay $5.25 cash for it. So I have to pay out all the shareholders. I'm going to exercise my right to buy it at $4, and then receive the cash. So, and if somebody knows of a loophole in that, call me, because I have an options principles license, and I can't remember. Or I held an options principles license one point in time. That's a very sophisticated license. But it was a long time ago. And actually, this is the first time this has ever happened to me. Somebody buys the share price out at a premium, and the share price drops. Interesting. Anyway, and by the way, if you'd like to call 216-901-0945, 216-901-0945, feel free to give us a call and ask us some questions. I'm talking too technical this morning, probably put a whole lot of people to sleep. Anyway, I think I've got a call here. It's Jerry. Hey, how you doing?
Professor Bullington, how are you this morning?
Good. How are you?
Good. Hey, I tuned in late, but I assume you're talking about this Genworth?
Yeah. Yep.
There was a big article. Actually, there have been two articles in the Wall Street Journal this past week. I don't know if you've seen them.
Yeah, I looked at all the headlines on it, and was nothing unusual. Every time they do a sale, by the way, a law firm jumps up and tries to challenge it because they can extract money out of the company that way.
No, these were editorial issues by the Wall Street about the Chinese firm that's buying them, correct?
Okay.
And they were saying that there's a very strong possibility it may not go through. As I said, I just caught on to it, and I would like to. Are you going to be on tomorrow? Is this going to be a repeat of tomorrow night?
It's just going to be a repeat. But that's the other thing I meant to mention. The deal could fall through, because just because they announced that they plan on doing it doesn't mean it's going to get approved. But I know the people at Genworth, they would really like to sell it. It's such a large company though, and the Federal Trade Commission could come back and say, nah, sorry, we're not going to let you do that. But that's always a risk.
Yeah, well, I'll tell you, if you didn't see it, I might be able to even email it down to you. It's a great article as far as the pros and cons on it. It was on Wednesday, if I'm not mistaken.
Yeah, it's just that I've seen so many of these, and I know exactly what they're thinking. Every time a deal like this comes through, you hear the same stories. Here's the pros, here's the cons. This is what might happen. And if you actually tracked the recommendations of the articles that are actually bold enough to make a recommendation, their hit rate's a little less than 50%. So that's one of the reasons I'm not super excited about it. Hey, Jerry, can you hang on for a second?
Sure.
Okay, thanks. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. Back. I can barely hear myself. Hey, Jerry, that's still there?
Yes, Bill.
Yeah.
I just had a moment here to look at the paper. It was on Tuesday and Wednesday's Wall Street, money and investing, and both sides, both dates. But bottom line is, if nothing else, if somebody's considering investing, it just has some pretty good information as far as all the background, so forth and so on.
Yeah. I generally, like I said, I'm looking for certain things. The opinion pieces, I don't pay a lot of attention to anymore, mainly because it depends on who it is. But if it's a journalist, I generally scan the headlines, and I've scanned the headlines on these companies. A lot of those stories, I just don't put that much faith in, because those guys are speculating and they're trying to figure out what the decision makers are thinking and how they're going to interpret the news, and then how they're going to rule on that. And like I said, more often than right, they're wrong more often than they're right most of the time.
The flip of the coin. But I would hope the information that, other than opinions they're putting down there, is accurate. But you're right. There's no. I mean, it should be implied, if nothing else.
Yeah, and here's the other thing. If you ever look at a financial statement, I mean, really look at one. And if you've ever gone through the looking at accounting rules, generally accepted accounting principles, there is so much interpretation that goes on. And I always like to say that earnings, profits, they're an opinion. It's actually
almost. Yeah, no, you're right.
Yeah, no, it's not almost. I mean, it is. It's just an opinion, and you will not.
Didn't the latest, the most recent regulation, Dodd-Frank and the likes of that, pretty much limit what they can do as far as window dressing?
No, not at all. Hell no. Especially with a non-bank. And they have to account for certain things. They still have an awful lot of financial leeway in that. It did restrict it, removed some of the things they were doing, but you're never going to get rid of all that. It's impossible to do. Yeah, you can't run a business the way that they run their business that way. It's impossible. At some point in time, somebody's got to make an estimate. And when they're estimating, their estimates are generally going to. Do you think they would? Well, I guess it depends. Some companies
they're going to favor the company, of course.
In some cases,
I would hope they would.
Well, there are a lot of cases where companies have always understated so that they look better when the numbers came out ahead of.
True.
Yeah.
So
you just don't know. I mean, you just don't know. You can tell roughly what their revenues were. You got a rough idea of how much raw cash came in over the past, over the quarters that they've reported for. But you don't know how that's going to be affected in the future. You can try to look at trends and forecast the trend, which is what almost all analysts do. Let's forecast a trend. And they just do that, observing what's already happened in the past and then extrapolating that out into the future. But
Bill,
go ahead.
I'm sorry, I didn't mean to interrupt you.
No, that's okay.
I was going to say, you were recommending this before the deal was announced, right?
Oh yeah,
January. That's what I thought.
And my thought process here's a dose of reality for people who like to rely almost exclusively on financial statements and reading the analysts' opinions. The board of directors and the CEOs are acutely aware of the profit margins that are average for their industry. They are acutely aware of that. They also know whether sales are going up and down. That they can try to have an impact on a marketing program. You don't know until it's worked or not until after you count the numbers and you see how much sales have gone up or down by. You can try to control your costs. But I will tell you this, they will, when you've got a lot of sales in a business and you've got a big business, it's relatively easy to cut back on costs and bump your numbers up, even if only temporarily.
Sure, of course.
And since everybody is aware of all the other companies that you compete with throughout the world, and they know what their reported profit margins are, they know what their cash flow is, there's an incredible amount of pressure on the management to perform at least as well as average. If you're not doing as well as the average company in your industry, why are you here?
Your head is on the block.
Yep. So that's why when you look at the price to sales ratio, when you see a company that's got a whole bunch of sales, but the market value is very small relative to the amount of sales, they can cut costs. Even if it's only temporary, they will cut costs, get those profit numbers up. Analysts tend to project that out into the future, and the stock price tends to take off.
Sure. I mean, you can do it on a small company if you.
You can do it on large companies. It's actually easier on a large company than it is on a small company.
No, that's what I said. You could do it on a small company just by holding back your receivables and pushing forward your payables on an annual basis.
Oh, there are There are 8,000 pages of generally accepted accounting principles.
Yeah,
they can do an awful lot of manipulation there. Well, my point is they're going to do whatever they need to do, especially like a company like Genworth, who has revenues. Yeah, I should have pulled up Y charts. Their revenues are enormous relative to the market value of their stock. And I'm actually, what tells me that management is really concerned is that they even entertained a price as low as they did to sell that company.
That makes a lot of sense, yeah.
Yeah, because evidently there's something that's wrong there.
So they know something. There's something in the closet.
Or somebody is, they've just had so much, they're just tired. They're fatigued and they're saying, you know what? Let's just sell it. We're just going to sell it.
As I said, I didn't have the benefit of hearing you prior to. I'll be listening tomorrow night. But does this mean, I think you were saying you would be a buyer of calls, but you certainly wouldn't be buying the stock. Is that correct?
No, actually, that's what I'm going to do. I already have calls in it, and they're down to more than half. I don't know what I didn't look at it Friday afternoon, but I have the right to buy it at $4. If this deal does go through, eventually before it goes through, the price goes back to the 5 something. If I take my loss on the original calls that I bought, and then I buy these, I should have, by the time I take the taxes into account, I'm probably going to break even. And if the deal falls through and they go through ahead with the plan that they had before they entertained this deal, which was to split the companies up, that could actually have a big impact on the total share price of the underlying companies. And that's why I bought it, because they were talking about breaking the company up, getting rid of when you do that, typically the companies that are the profitable ones, their share prices tend to go up a lot.
Correct.
And the option price is on the combined total of all the companies, not just the one that went up. So if a couple of them go up enough, it'll carry the weight for the other for the dogs, and you can make an enormous amount of money in that. Occasionally, go ahead.
I was just going to ask, did you detail this in your soliloquy a few minutes back, or no?
No.
No, you did. Okay, I'm just asking. So, as I said, I'll be listening tomorrow, and I definitely want to hear what you say about it.
Yeah, actually, tomorrow's just a replay of today.
Right, that's what I mean. Because I didn't hear the first half of the show.
Oh, okay. You can get it on iTunes too. It's on iTunes and it's on iHeartRadio, and you can actually download it from our website. So if you miss it, you can pick it up on the website too.
All righty. Hey, one other thing. I asked you about Schulman, and you said that you really couldn't talk about it.
Yeah, we're still not allowed to talk about it.
You're still not allowed to. Okay, yeah. Very, very good.
All I can say is it came up on a momentum scan this week.
Okay, I'll be watching it then.
Came across one of my scans. Yep.
Thanks for the heads up.
All right.
Okay, thank you, Bill.
Have a good weekend.
Take care now.
Yep, thanks.
Yeah, bye-bye.
And that was the interesting. Hey, by the way, there were one of the things I'm doing that we're going to talk about at the seminar is actually I only have 60 seconds left and I can't get it done in that. Tune in next week and we'll talk about that. It has to do with Telechart doing the scanning. The company that he just asked about, it did come up on a scan. We can't talk about that business because somebody has a close relationship, actually works for that company that's related to somebody at our company, and we're not allowed to talk one way or another, and nobody's allowed to buy positions in it in our firm. So anyway, unfortunately, that's just kind of how that goes. But feel free to email me too. If you hear something through my show and you'd like me to talk about it, I'd be glad to try to get it working into the program. In fact, we've got a lot of help from people over the years that have had questions like that. Remember about the annuity thing. If you want a comparison before you invest in one, for sure, we've got a database on every variable annuity in the country. The equity indexed annuities, you actually have to get a description of the product. But now that I hear the music, I guess I'm going to have to cut this short. You're listening to Bill Bullington. I'm here every Saturday noon from 11 to noon on 1420 The Answer and 6 o'clock on 1220, our sister station. You Go to Bullington Capital to find out, bullingtoncapital.com to find out more about my firm. Thanks for listening, everybody. Have a good week, good investing, and good luck.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420, The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.